Supply and demand zones. A technical analysis assessment, in my opinion, is number one, and it does take time to train your eye on how to catch it. And there are a couple things you need to know before you can actually apply it. We're going to start our day by looking at the US dollar and Canadian. When applying your supply and demand zones, it's always best to look at the higher time frames. The higher time frames are way more accurate than the smaller ones, but you can break down those higher time frames to get a more accurate reading of the supply and demand zones, which we'll see in a minute. So once we go here, first thing you need to know is impulse, balance, impulse. Some people may also call it rally base drop, drop base drop, rally base rally. And what that is it's when you see a candle, this right here would be a drop or impulse, because look how much it moved within the daily time frame. And then this right here, these candles would be considered balance or base, because it was a major drop and then it just stops. So base or balance. And then after that, you're going to want to look for another impulsive candle like so. So those are impulse, balance, impulse, or drop, base, rally. That is what that is. So we're going to look for some, and we can see that there's some here. There's obviously some that's going to happen right here. And so now we're going to break it down to the 4 hour. So we can see right here. Let's zoom in this area. So we have drop, a little drop right here, balance, and then an impulse. So we're going to get one of our tools here. We're going to get one of our tools here and create our demand zone. You're going to want to put your demand zone at the close of the candle all the way to the wick and come all the way over and set it. This is our demand zone. Another thing is how many times that demand zone has been touched. So we can see it's already been touched one time. So after it has hit the close, the next candle opened up, reached all in, and then began its move back up. So now we'll find a supply zone. So this right here will be a supply zone, but we're going to have to break it down. We'll break it down to the 1 hour because we're on the 4. All right, now we can really see it. Now we can really see it. So we have rally or impulse, balance, and then an impulsive move down. So now we're going to mark this, put it at the close of the candle, all the way to the top of that wick, and bring it over. And because that is a sell zone, now we're going to make it red. So now we have two: demand, supply, drop, balance, rally, or impulse, balance, rally. So the reasoning why you want to see how many times it's already been in there is because this lets you know if this supply or demand zone is valid anymore, or it gets weaker over time. So we can see it's been all in here already. It's already been touched. So after it goes up, now we have another rally, base, drop. So now we have a zone in here. Never been touched though. So now drop, we have a touch right in here. We got a touch right in there, this little area. So boom, it's already been touched one time. It's gotten weaker. So now this one, it's already been touched quite a few times, And now look, we have this slight little touch right here. So now that we have that little touch, now look, it's already beat up. It's likely no longer really applies anymore. So this demand zone isn't really much to look for anymore. So now look, if I were to have extended this some, you see, now it's just all in there. Now they're not even respecting this demand zone anymore. So this one's no longer valid. It's no longer valid. So that is a way of using supply and demand zones and how to break it down. Now, it does take practice for you to constantly look at the charts over and over and over, looking for them. Sometimes you might still think a demand or supply zone is still valid when it no longer isn't, but take time to use it, because this shows where the market is likely to really reject from, because when there's major impulses like that, that means a lot of money is put in that zone. There's a lot of liquidity. There's a liquidity pool in there. So that's why when the market goes back and touches it, it's hitting all those unfulfilled orders or those limit orders that's just been sitting there, which causes price to move back up or down.